India has two interest rates that everyone watches, and the space between them tells a story. One is the repo rate, the Reserve Bank's overnight policy rate, set today at 5.25%. The other is the 10-year government bond yield, which the market itself sets sitting near 6.7%. The gap between them, about 1.5 percentage points, has a name, the term spread. It is not just a number. It is the bond market's forecast of the next decade, printed in real time. Let's open up the machine. Why does the gap matter? Because the two rates measure different time horizons. The repo rate is about right now the price of overnight money, and the Reserve Bank controls it directly. The 10-year yield is about the future. In theory, a long yield is roughly the average of what the market expects the overnight rate to be over the next 10 years, plus a cushion called the term premium for the risk of holding money that long. So when the 10-year sits above the repo, the market is effectively saying it expects rates, growth, or inflation to be a little higher on average over the coming years than they are tonight. Read the size of that gap, and you are reading the market's outlook. Let's set the scene. Over the last 6 weeks or so, India's 10-year yield has fallen by roughly 37 basis points, easing from just above 7% to around 6.7%. Three things helped. Crude oil dropped about 21% through June, cutting inflation fears. Foreign money poured into Indian bonds, and the monsoon looked supportive. Meanwhile, the Reserve Bank did nothing to its policy rate. In June, its committee held the repo unchanged at 5.25%, unanimously, with a neutral stance, so the long end moved while the short end stood still. The spread narrowed, and that raises the real question. What is the market pricing when the 10-year drifts toward the policy rate? Here's the machine inside the spread. Break the 10-year yield into two pieces. Piece 1, the expected path. Take the repo rate today and imagine the market's best guess for where it goes each year for a decade. Then average it. If the market expected aggressive hikes, the 10-year would sit far above the repo. If it expected deep cuts, the 10-year could fall close to, or even below, the policy rate. Piece 2, the term premium. That is the extra yield investors demand for locking money up through 10 years of inflation and supply uncertainty. Now put it together. A moderate, positive gap of around 1.5 points, with the long end falling, says the market expects policy to stay roughly steady to slightly easier, with inflation contained rather than running away. The Reserve Bank sets tonight's price. The bond market is quietly voting on the next 10 years. So what does a narrowing spread actually do? It lowers the cost of money across the economy, even though the Reserve Bank has not cut a thing. The 10-year yield is the benchmark that prices government borrowing, corporate bonds, and the discount rate on stocks. When it falls 37 basis points, the government's interest bill eases, companies can borrow a little cheaper, and equity valuations get a softer discount rate, all without a single policy move. And notice where it came from. This easing was delivered by the bond market through falling crude, foreign inflows, and calmer inflation, with the central bank forecasting inflation around 5% for the year. The market did the loosening the committee chose not to. So here's the lens to keep. Don't just watch the level of any one rate. Watch the gap between the overnight policy rate and the long bond, because that slope is a forecast. A wide, steep spread says the market expects higher rates, stronger growth, or more inflation ahead. A narrow spread, like the one closing in India now, says it expects steady, easier conditions with inflation under control. And a spread that flips negative, with long yields below the policy rate, has historically signaled the market expects the central bank to be cutting soon. It won't tell you exactly what happens next, but it tells you what the bond market is betting on right now, with real money. So the next time the RBI holds steady, don't assume nothing moved. Check the spread. This channel explains how markets work. It is educational, not financial advice.